Ladies and gentlemen, this week, Goldman Sachs reversed its view and announced that the Federal Reserve will cut rates in December. The market cheered, but applause does not change the data. And today, we are not here to follow expectations. We are here to stand with reality, because when you look closely, when you cut through the noise, the Fed's message is very different from what the market wants to hear. Inflation is still running at 3.2%, and core inflation remains stubborn at around 3.5%. The most important component, core services, is not cooling at all. This is not the backdrop for a rate cut. This is the stance of a central bank that is cautious, uncertain, and far from ready to ease. And then we look at the labor market. In August 2025, the United States added only 22,000 jobs, one of the weakest readings since 2020. The November services PMI is at 52.4, showing growth in services, but hiring remains soft. Quit rates are falling. Weekly hours are falling. Yes, the labor market is weakening, but it is not breaking. And the Federal Reserve does not cut rates when the structure bends. It cuts when the structure breaks. We are not there. And while the market is distracted by narratives, the most important signal is hiding in plain sight. The Fed's balance sheet is still $6.7 trillion, and quantitative tightening has slowed dramatically. Now only about $5 billion in treasuries rolling off per month. This is not preparation for a celebration. This is preparation for liquidity stress. A defensive move, not an easing cycle. Inflation too high. Labor soft but intact. Liquidity tightening quietly, yet the market continues to dream of rate cuts. We do not dream. We look at data, and the data tells us clearly the Fed is unlikely to cut rates in December, but that leads to the real question. What happens next if the Fed doesn't cut? The market is positioned for a cut, so a no-cut decision will not collapse the system, but it will shake the surface. Stocks will feel it first. The S&P 500 may swing sharply. The Nasdaq may drop harder because growth stocks are sensitive to interest rates. Commercial real estate, high-debt companies, and speculative tech will feel the pressure. This is not a crash environment. This is a volatility environment. Gold, on the other hand, behaves differently from what most investors expect. If the Fed holds rates steady but speaks cautiously, gold rises. If the Fed avoids sounding hawkish, gold rises even more. Gold does not react to cut or no cut. It reacts to uncertainty, to liquidity stress, and to the future path of monetary policy. Silver will move with more volatility, but it will not collapse. The US dollar will jump in the short term. Treasury yields will spike as the market readjusts, but the medium-term trend will depend on the Fed's tone, not merely its action. And what about the banks? There will be no systemic break, not when the Fed is still holding $6.7 trillion in assets, not when QT is slowing, not when the central bank is actively preventing liquidity fractures at the end of a cycle. Small banks may feel pressure, but the system holds together. The only thing that truly breaks is the market's incorrect expectation. So, ladies and gentlemen, if the Fed does not cut in December, this is what we face. Stocks shaking, gold strengthening, the dollar jumping, yields rising, liquidity tightening, and volatility returning. But not collapse. Not a crisis, not the end of the system, and that is why we do not follow narratives. We follow data. We follow signals, not noise. And when the dust settles, truth always wins. In a noisy world, data is signal. Truth is signal. That's why we stand exactly where the numbers lead us. If this helped you see the Fed's message more clearly, make sure you stay with me, because in my next video, I will break down the most important question of all. What happens after December? Will the Fed be forced to cut in early 2025, or are we heading into the most misunderstood phase of this cycle? The market is preparing for the wrong story. Let's prepare for the right one. Subscribe, stay sharp, and I'll see you in the next video.